All right, welcome everyone. Thank you for joining us. Welcome to our webinar today on earning trust, what investors are expecting from financial professionals. Before we begin, I'd like to share our upcoming calendar of webinars. We have 3 scheduled for June. On the 18th with CFA UK on open innovation. On the 22nd, an advocacy topic on Green Deal. And on the 30th, a webinar on the new ESG investing certification. We also have 2 additional events in July, one on IFRS and another one on soft skills. Invitations will be sent out shortly. Please note, all our webinars are now available on replay and can be found on our YouTube channel, our website, and our LinkedIn page. Please feel free to like and share. We are now ready to start the webinar. I'd like to go over a few housekeeping rules for this session. All mics and webcams are turned off. Please do not switch them on, as we'd like to guarantee a decent internet connection. Today's session will be led by Rodri Priest and Philippe Maupas. We will have a Q&A session at the end of the webinar. Please use the chat to ask any questions during the presentation. You will also be able to ask questions by clicking on the raise your hand icon that's available in the participant tab. I'll then call on your name so you can ask your question. Let's give it a try. Could you all raise your hands if you understood the housekeeping rules? All right, I'm starting to see some hands. Great, thank you for your participation. Jean-Philippe Dor, President of CFA Society France, will now introduce our speakers.
Yes, thank you, Marie-Alix. Good afternoon, everyone, and welcome to this 6th webinar since we launched our webinar series back in May. I'm pleased to introduce this webinar, which will cover a survey commissioned by CFA Institute on how retail and institutional investors trust investment professionals and trust their financial environment. As you will see, this is not only an assessment, but also a guide on how asset managers, banks, insurance companies, wealth managers can fully align their interests and better serve their clients. To present this report, I'm pleased to welcome Rodri Priest. You know where Rodri is head of industry research at CFA Institute. Rodri is involved in many fields of research across CFA Institute, including a research foundation, which is celebrating its 75th anniversary this year, including the Future of Finance project as well, and of course, the Financial Analyst Journal, or the FAJ. To share the French perspective on this survey, I'm pleased to welcome Philippe Maupas. Philippe is a long-time volunteer in our society. Philippe was president of CFA Society France between 2012 and 2015. He serves currently at CFA Institute Disciplinary Committee, and Philippe is a co-founder of Alpha & K, an independent financial advisor. As you all know, we are going through particular times, and investor professionals have a great opportunity today and a unique responsibility to be part of the solution. So I'm convinced this webinar will help us to reach our common objective. Rodri, the mic is yours.
Thank you, Jean-Philippe, for the kind introduction, and thank you, CFA France, for inviting me to present the findings of our investor trust study today. Hello, everybody. It's a pleasure to be involved and to be doing this presentation today on earning investors' trust. It's our latest research study to come from our Future of Finance initiative, which is really our thought leadership agenda within CFA Institute. And the topic of trust is one in which we have tackled before. We do this exercise every 2 years. The current study is the 4th version of our trust study, and it provides us an opportunity to take a check on how is the industry performing in the eyes of its clients, the retail investors, the institutional asset owners? What is their level of trust in the financial firms that are acting on their behalf to manage client money? So we feel that this is an interesting exercise. It's a useful exercise for us to understand perceptions in the industry. And to do this, we partnered with a firm called Greenwich Associates. It's a large capital markets consultancy firm. They have access to a wide survey pool. We've conducted an extensive survey of retail and institutional investors for this study across 15 different geographic markets, and I'm pleased to present the findings today. So, why do we do this study? Well, the central concept here is, what does it take for someone to put their capital at risk and entrust their funds to someone else to manage? Trust is a multi-layered concept, and we think it's essential to the proper functioning of capital markets. If you don't have trust, then financial interactions become much more costly or inefficient, or they won't happen altogether. So trust is really necessary to make sure that the financial industry can operate, can process transactions, and that markets can function efficiently and effectively. So as I said, we conducted this study with Greenwich Associates. We've looked at 15 different geographic markets, which are listed on this slide here, including France. And the total survey pool is just over 3,500 retail investors and 921 institutional investors. These are asset owners coming from pension funds, endowments and foundations, insurance companies, and sovereign wealth funds. So it's a pretty extensive survey pool. In this version of the study, we've added 3 new markets, that is Japan, Mexico, and South Africa. In the previous version of the study, we only covered 12 markets. So we've expanded market coverage and the survey pool in this iteration of the trust study. And the way in which we look at trust is across different layers of the investment industry. So we consider trust at the financial system level, at the industry level, and at the firm level. And across the different layers of trust, we identify these 3 key concepts. Firstly, information. Information is essential for trust in the system. Information is the bedrock on which investment decisions are made. And if financial actors don't feel they have sufficient information, then that can impair and reduce their investment decision making. So information is one of those foundational concepts that lies at the heart of the concept of trust. Secondly, we look at innovation. And this really speaks to the ability for investment firms to create products, strategies, business models that meet the needs of clients. How can you innovate and create new products and strategies that are catered to the specific needs of your target audience? And here we see technology playing a crucial role in innovation. And we also see that technology can have an important role in increasing trust. We find that firms that have increased their use of technology are able to generate higher levels of trust amongst their stakeholder base. And finally, we look at trust in the firm level. Here, trust in the firm speaks to the ability, or the desire rather, for end investors to have influence and control over their relationships and their transactions with firms and financial advisors. That's clearly a very important aspect in terms of building trust, and also speaks to the increasing desire for end investors to have more customized, more tailored investment products and solutions that meet their specific needs. How can you influence that relationship with your advisor such that the advisor is there to serve your specific needs, create customized solutions for you, provide low fees, and really earn your trust by providing value? So we look at this concept of influence and control, particularly at the level of the investment firm. After going through those 3 concepts, we'll conclude this presentation with a look at what we call the CFA Institute trust equation. What are the specific steps that you can do as an investment professional to build trust? And that looks at elements including, how do you build your credibility? How do you boost your professionalism? We believe that these are the concepts that deliver value and can enhance trust in client relationships. So just as more context as to why we do this study, we find that trust can be the #1 factor in manager selection for retail investors. We asked our retail investor sample, what is the most important attribute when you're hiring an asset manager? And a relative majority of the respondents cited trusted to act in my best interest as the most important attribute. That was cited by around 33% of retail investors, and that's pretty much unchanged from the 2 previous versions of the trust study that we've done. For institutional investors, trusted to act in my best interest is the second most important attribute, alongside the ability to achieve high returns. But what this slide really does is just underscore the fact that trust is central to those decisions on which manager to hire to act on your behalf. So let's dive into the results. And as I said, we're going to break this down into 3 sections: trust in the system, trust in the industry, trust in the firm. And at the system level, we see in particular the importance of information in building trust. So starting off, we took a look at what are the levels of trust in different industries, including financial services. The chart on the left shows you retail investor trust levels in different industries. This is showing the proportion of respondents that said they trust that industry highly or very highly. And you see that amongst retail investors, financial services performs relatively poorly. Only 46% of those retail investor respondents said they had a high or very high level of trust in financial services. And that's little changed from the previous trust study that was done in 2018. It's actually up just 2 percentage points. On the right-hand side, you see institutional investor trust in different industries. Generally, institutional investors have much higher levels of trust in different sectors, on average around 15 percentage points higher trust levels than retail investors. In financial services, for example, you see institutional trust levels at 65%, so a lot higher, but noticeably trust levels are down quite significantly on 2018 levels. In financial services, we see institutional investor trust levels down by 7 percentage points. And for technology, which is actually the most trustworthy industry amongst our survey pool, we actually see trust levels down by 12 percentage points from the 2018 study. So a very high level of trust in technology, but it's also experienced the biggest reduction in trust amongst institutional investors. Looking geographically at those results, you see quite a wide spread of trust levels across the 15 different markets that we've covered here, ranging from a low of 24% in Australia, which has had a huge financial services scandal in the banking and superannuation industries. It led to a royal commission into conduct in the banking and insurance sector. And we believe that's had a negative impact on retail trust levels in Australia. You're seeing only 24% of respondents there saying that they had a high or very high level of trust. Across the board, it varies quite significantly, as I said. On the other end of the spectrum, you have 87% of respondents in India saying that they had a high or very high level of trust in financial services. In Europe, it's a bit more of a mixed picture. France comes out with 39% trust amongst retail investors, which is a little higher than the UK or Germany. So on one of the previous slides, I showed you the trust gap between retail investors and institutional investors. What we also see is that there is a trust gap between retail investors with an advisor and those retail investors without an advisor. That's shown on the left-hand panel of this slide here. So while 65% of institutional investors have a high trust level in the financial services industry, we see that among retail investors, there is a 24 percentage point difference in trust levels between those investors with an advisor and those without an advisor. Retail investors with an advisor are far more trusting of the financial services industry than those without an advisor. And that carries through to specific subsectors of financial services: financial planners, investment management firms generally, private wealth. Those retail investors that have an advisor are far more trusting of those industries than retail investors without an advisor. We believe that probably speaks to the importance of information in the system. It's likely that retail investors that have an advisor have greater information or greater access to information. In turn, that gives them more confidence on which to base their decisions, and that can support trust. So I should have mentioned at the start, we conducted this survey in late 2019, so clearly before the COVID-19 pandemic kicked in. But we did ask this question about how well you believe your firm's ability is to manage through a financial crisis. And encouragingly, we had 68% of institutional investors saying that they thought their firm was well prepared to manage through a financial crisis, but just under half of retail investors thought that their firm or their advisor was well positioned to manage their portfolio through a crisis. So some uncertainty there on the part of retail investors as to how their assets would perform, how their strategy would be catered to in a financial crisis. And of course, this is very much the environment that a lot of retail investors are living through at the moment, which we believe will put a strain and a test on trust in those advisor-client relationships. One of the important themes in this trust study is around retirement systems, pension funding, and so on. And here we see some concern that among retail investors, there is a view that pension fund benefits will have to be reduced downwards in the next 10 years. Around just under half of respondents said that they thought it was likely or very likely that pension funds would have to mark down benefit payouts in the next 10 years. And another third thought that it was possible that pension funds would have to reduce benefits. Only 15% thought it was unlikely or very unlikely that funds would not have to reduce their benefits. So I think this speaks to concerns around pension funding, particularly given the backdrop of lower for longer interest rates, lower for longer capital market return expectations, the strain on government fiscal deficits, rising debt levels. That's all obviously been exacerbated by the COVID-19 pandemic, as well as longevity. So we're seeing people living for longer in retirement and a relatively smaller proportion of workers, of working age population to support those retirees. So when you put all of those factors together, that clearly creates a stress funding situation for pensions. And we're seeing here the respondents expressing some concern about the ability of pension funds to follow through and deliver on those promised benefits. So we also asked retail investors, if you're eligible for a state-sponsored financial benefit in old age, do you trust it will pay out benefits as promised? Generally, retail investors felt that, yes, they had trust in state-provided pension payments. That's 68% at the overall level. But again, you see some significant variation across countries. France is one of the countries that has relatively low levels of trust in state-sponsored financial benefits. And with that, actually, I will pass over to Philippe, because we have here the first cut of the French market data, looking at this section on information in the system. Philippe, perhaps I can pass over to you to talk about the France-specific results on this section.
Yes, thank you, Rodri. I'm Philippe Maupin. I will try to provide some color on the French part of the survey. France is not known, well, the French people is not known for their trust in anything. We don't trust the government. We don't trust finance. Those of you who were around in 2012 might remember the presidential campaign. The then socialist candidate, François Hollande, who was to be elected president, famously said that he had an enemy, a faceless enemy, and that was finance. So we don't trust the institutions, we don't trust finance. That being said, as Rodri showed earlier, the level of trust in the financial services industry is not that bad in France, which surprised me, I must say. It's higher than in Germany and in the UK. It's close to the level of trust that the American people have. That being said, when we dig a little bit further and ask the French investors whether they have confidence in receiving state-sponsored pension benefits, the level of confidence of French respondents is much lower than the global level, with a level of 55%, which is a majority, but it is much lower than the overall level of 68%. And this is worrying because we all know that there is nothing else than the state-sponsored system in France. We have a private pension system that is very, very, very small. And when we ask them whether they believe that their investment firms are well prepared to manage their portfolio through a crisis, we got the same discrepancy between the global appreciation and the French appreciation, 32%, and that's 1/3, and that's very low. Of French respondents have confidence in their investment firms to manage their portfolio through a crisis. We went through a crisis. It will be interesting to see the results after the crisis. That's it for the French perspective.
Thanks, Philippe. So moving on to the next section of this presentation, we'll now look at trust in the investment industry. And in particular, we want to focus on this concept of innovation and see how technology play an important part in supporting trust levels. So firstly, we went to specifically examine this issue of increased technology on trust levels, and we asked, how does the increased use of technology affect your level of trust in your advisor or your asset manager? And we see around 2/3 of institutional investors saying that they trust their advisor or their firm more as a result of increased use of technology. For retail investors, it's just under half of respondents saying that they trust their advisor or their manager more because of increased use of technology, but that's up quite significantly on the 2018 level. So generally, we see this trend towards technology becoming more important and seen as one of those attributes that can increase trust level. So while technology is becoming important, we're also seeing that in the coming years, it will become even more important. So we've asked this question in the previous 3 studies. In 3 years' time, which of the following do you think will be more important to you? So having access to the latest technology platforms and tools to execute my investment strategy, which is the blue bar here on this chart, or having a person to help navigate what is best for me and execute on my strategy. So clearly individual human advice is still a very important part of the value proposition, but we see that importance is eroding and is decreasing over the last 3 versions of this trust study, to the point where we are now in 2020, where there is an even split in importance between having access to technology and having access to a person to help navigate my investment strategy. So in relative terms, we see the importance of trust increasing and the importance of access to a human decreasing. That said, though, as we currently stand, individuals still prefer advice from a human over a machine, over a robo-advisor. The bottom of this slide here, we use the concept HI to denote human intelligence, and we see that 73% of retail investors still prefer access to a human advisor over a robo-advisor. So right now, humans still clearly have an important part to play in the provision of financial advice. But looking forwards, looking into the future, we see that technology will gain relative importance. We also asked a question around, would you invest in a fund that primarily uses artificial intelligence to select investment holdings? Institutional investors are much more disposed to saying yes to that question, and much more interested and keen to allocate money to an AI-driven investment fund. That was cited by 71% of institutional investors. Retail investors have more mixed views. It's an approximate even split between those that said yes, those that said no, and those that said not sure. So, clearly in the retail space, human advice is still the primary driver of trust and value, but institutional investors and some retail investors are increasingly becoming more interested in and disposed to products and funds and investment strategies that employ artificial intelligence. So we also looked at this issue of innovation and wanted to understand, how does innovation, the ability to innovate, support trust levels amongst your clients? Here we find that institutional investors and those retail investors that have advisors, we saw earlier that retail investors with advisors have higher trust levels generally. They're also more likely to be early adopters of new and innovative investment products. You see quite a big difference actually between those with an advisor and those without an advisor, again, underscoring this trust gap between these 2 cohorts of retail investors. 75% of institutional investors said they were likely to be early adopters of product innovation. which I think speaks to, again, this opportunity to create customized, bespoke products that meet the specific needs of your client base. We also wanted to examine the extent to which technology firms could be potential competitors to financial firms. I think there's been a lot of talk and concern amongst the financial industry. Could one of the big tech giants enter the financial industry, particularly in the distribution space, and gain market share from some of the established players? And here I think it was very interesting to find that there was almost an even split amongst investors who would be interested in investing in a product that was created by a financial institution or a product that was created by a large technology firm such as an Amazon or a Google or an Alibaba. So only narrowly there for financial institutions. And I think that result really underlines this fact that there is relatively high levels of trust in the technology sector. We saw that trust in the tech sector had come down, but it's still at a very, very high level. It has the highest level of trust amongst institutional investors. And perhaps because of that, there is, again, a predisposition to new products or services that could come from the tech sector, potentially disrupting product innovation and distribution in the traditional financial industry. Philippe, over to you to talk about innovation and technology and trust in France.
Yes, not much to add for France in terms of color. The overall results about the importance of access to tech versus advisor are quite similar to the global results. The French are equally open or not open to consider investments using artificial intelligence, retail advisors. And they trust advice more than from humans, much more than from artificial intelligence or robo-advisors. Some color on the robo-advisory scene in France. There are two dominant robo-advisors, Yomoni and Nalo. One releases data and the other one doesn't, but it can be stated that together they manage less than 200 million euro, which is absolutely nothing, and it's very telling as to the appetite of French retail investors for technology provided by robo-advisors. That's it for me.
Okay, so on to the third section of our deck here, looking at trust in the investment firm. And here we want to focus on this concept of influence and control, the desire for greater influence but amongst clients in their interactions with their advisor or the firm that is entrusted to act on their behalf. Unsurprisingly, fees are a very important part of the client-advisor relationship. Fees are one of the few things that the client can control to the extent that fees are known in advance, whereas returns are not. So clearly having those negotiations with your firm or your advisor to manage fees to an acceptable level is an important part of the conversation. We see that 65% of institutional investors have renegotiated manager fees within the last year. And we also see that 83% of retail investors agree that one of the most important items in creating that trusted relationship is full transparency and disclosure around fees and costs. I think that's been an issue, that's been a challenge for the industry in general for a number of years. Clearly, there have been a number of pushes by regulators and other institutions to require greater disclosure, transparency around all fees and costs related to investment products. We see a lot of that coming at the European Union level, MiFID II, for example, as well as some local regulatory initiatives to deliver greater transparency around costs and fees. And because it's one of those important aspects that really can have a big impact on the trust in your relationship with your firm or your advisor. So, speaking to this concept around the desire for greater influence, it also refers to the desire for greater demand for personalized products and services. And we wanted to explore, okay, we understand that retail investors say they would be interested in investing in more personalized products, but would you be willing to pay more for that? And we found that around half of retail investors in total would be willing to pay more for a personalized product or service. That's much less pronounced amongst the older generational cohorts. but amongst younger generation investors, particularly millennial investors, they are much more likely to be willing to pay more for a product or a service that is personalized. In other words, something that aligns to their personal values and beliefs. We see a lot of this happening in the ESG space. Clearly, there's been a huge demand for more ESG-themed investment products and strategies, and partly because of that reason, that people feel they can express their own views, their personal values through their investment decision. And ESG is one way which allows retail investors to express those personal values, and that's particularly important amongst younger generation investors, to the point that they're more predisposed to pay more for those sorts of products or services. So clearly, there's a customization opportunity here for the investment industry. So staying on the topic of ESG, we found that around 2/3 of the respondents said that the trend towards greater ESG investing has increased trust in the investment industry. And around 69% of retail investors and 76% of institutional investors have made it clear that they have an explicit interest in ESG strategies. The motivations for ESG investing differ somewhat. This chart on the right-hand side explores the different motivations for ESG investing. Amongst institutional investors, a relative majority said that they expect ESG investing to result in higher risk-adjusted returns. So the motivation there is primarily a financial one. And we have seen ESG-themed funds perform very well in the current COVID-19 pandemic. So I think there is some good anecdotal recent evidence that supports this assertion that ESG investing can result in higher risk-adjusted returns. Amongst retail investors, we see a larger proportion, a relative majority, in fact, of retail investors who said that their motivations for ESG investing were to express personal values, to invest in companies that have a positive impact on society or the environment. So again, that underscores this customization opportunity for the investment industry. And again, those trends are a little bit more, actually, they're well pronounced throughout the different generational cohorts. Interestingly, here you see younger investors, actually, those who have expressed an interest in ESG, younger investors actually cite financial risk-adjusted returns as being relatively more important to them than older generations. Philippe, I will pass over to you to talk about ESG and influence and control in the French market.
Thank you, Rodri. French investors, as investors elsewhere, want also greater influence and control. One caveat on the advisory scene: you all know that there are very few independent financial advisors, and that distribution of financial products is controlled by the large French banks. You also probably know that the French regulator chose not to ban inducements after the introduction of MiFID II. So today, the networks are compensated by product providers via inducement, as we call them, retrocessions. The French investors are equally likely to leave an advisor because of underperformance, a little bit less than globally, but still 38%. Fees is an issue for 34% of them when they are too high, and the lack of communication for 32%. No significant difference compared to the global results. That being said, fees are not frequently discussed. There is a dramatic lack of transparency when it comes to disclosing fees, even though, as per MIF and PRIPS, in theory, fees should be much more transparent. In practice, it's still not the case, and fees are still buried in the footnotes of statements sent to advisors. French investors have an interest in personalized investment products, but I think that the way the question is framed is likely to elicit a positive response. If you are given the opportunity to have something more personalized, you're likely to say, yes, I'm interested. France is a very fertile ground for ESG investing. It started in the institutional space with some very innovative and groundbreaking legislation. It's now percolating into the retail space. You probably know that the life insurance products, which are the most popular way of investing in France, have now to reference at least one socially responsible investment fund. So that's it for the influence and control for French investors.
Thanks, Philippe. So that really concludes most of the survey data. Now we want to sort of turn to what can you do as an investment professional to increase trust and build credibility, particularly in this time of strains in terms of what's happening in the financial markets, the global pandemic, the dislocation in asset prices. All of these issues really put the core concepts of trust under strain. So how can you navigate that backdrop to build trust with your clients and strengthen those relationships? So we talk about the trust equation in CFA Institute: credibility plus professionalism equals trust and value. What can you do to build credibility and professionalism? Well, when we talk about credibility, we really talk about these are the signals that you give to your clients that demonstrate that you are trustworthy. They include having a track record, having professional credentials, and adhering to industry codes and standards that show that you and your firm is committed to the highest standards of professional practice, putting clients first. We see brands actually as being very important to trust as well. When we've explored that issue in our surveying data, we find that having a brand I can trust persistently ranks very highly in terms of what are the drivers of trust. So those are the core components of credibility that we believe are important and essential to building and maintaining trust. The other part of the equation is professionalism. This is really more of the intangible issues. It's really about mindsets. You know, how can you adhere to a client-first mindset? It's really about strengthening professionalism by continuing to invest in knowledge, education, professional skills and competencies, and having that ethical, client-centric professional orientation. Transparency is clearly part of that as well. We've seen that issue with the discussion around fees and costs in the industry. Being transparent, being committed to competency, and continually improving your knowledge and competency are all aspects that can demonstrate greater professionalism. In turn, the combination of those two things, we believe, can lead to greater trust and value creation for the client. So these are the underpinnings of building those strong client relationships. And they're really what give an advisor or a firm the social license to operate. If you can't demonstrate credibility and professionalism, over time trust will be eroded and you will lose that client business. So this slide really just recaps much of what I just said. At the end of the report, we kind of outline these 8 steps to increasing trust. As I said, strong brand identity, very important part of that, as well as having professionals with credentials, a good track record, and a strong code of conduct that reinforce that firm commitment ethics. And on the professionalism side, as I said, transparency, particularly on fees, but also using clear language to demonstrate that client interests come first. A lot of times the communications from the financial industry are suboptimal, let's say, not always clear or as clear as they could be or should be. Using clear language when communicating with your clients is a great way to build their trust. Showcasing your ongoing commitment to professional development through investing in your knowledge, your skills and abilities. CFA Institute, CFA Society France, that's something that is a very important focus of what we do. It's part of our offering, our value proposition to investment professionals and CFA members. We have a wealth of educational resources to help professionals maintain their knowledge and competency. And we're continuing to invest in our professional learning programming to give our members and other professionals the educational opportunities that they need to really live up to that commitment to lifelong learning and improving investment knowledge. And then finally, just demonstrate your dedication to client values. Understand what it is that motivates and drives your client. Develop an investment strategy that is tailored and customized to meet their investment goals, and be a great communicator to show that you understand what it is they're trying to achieve and that you can build up a track record that meets those objectives. So with that, I want to say thank you for listening to this presentation. We have a dedicated website for this trust study. It's trust.cfainstitute.org. Please do have a look at that at your leisure. There's a wealth of data in there. There is market-specific data for the 15 different geographic markets we've covered, including France. So please take a look at that at your convenience. And with that, we have around 15 minutes remaining. So I will pause here and hand back to Marie-Alix should we have any questions to answer. Thank you.
Thanks, Rodri. So for this Q&A section, so Rodri and Philippe will turn on their cameras, so it'll be a bit more interactive. We did have quite a bit of questions come through the chat. The first one being, is trust positively correlated to competence? Retail trust lower than institutional investors?
Yeah, that is a good question. I think it comes back to, and if I can link it back to the themes that I've spoken about today, I think it comes back to information a lot of the time. Clearly, institutional investors, this is their profession. They're very well informed. They have access to all sources of information and knowledge, and that gives you greater confidence in your decision-making capabilities. So I think it's not surprising that generally institutional investors are have higher levels of trust, because I think they have greater access to the tools that they need to, as I said, underpin decision making. You know, if you think about information, as I said at the start, it's really the bedrock of any financial transaction. It's the basis on which decisions are made, and the more confident you feel about your information set, then the more trusting you are likely to be of that transaction, of that relationship. So I think that's not surprising that we see higher trust levels there amongst institutional investors. And if I carry that through to the retail side, we also see a similar pattern with retail investors. As I said, retail investors that have an advisor, maybe they have greater access to information, sources of knowledge, and they tend to have higher trust levels than those retail investors who don't have an advisor. So yeah, it's an interesting question, but I do think information is one of the concepts that really drives those results.
Thanks, Rodri. Our second question, could you share your views on the role of regulation in trusting investment professionals beyond the key themes mentioned during the presentation?
So the role of regulation in trusting investment professionals, I think, you know, there's two parts to that. I mean, firstly, regulation has a role to play in terms of creating the standards, creating the frameworks for professionals to operate in, which sort of sets a minimum level of expectation as to what you as a client of the investment industry can expect. So you should expect that your professional is transparent and is committed to putting your interests first, and can make appropriate and suitable recommendations that are in your best interest, because that's what the regulation requires that individual to do. But of course, if you can, as a professional, you should be looking to go above and beyond the minimum requirements of regulation, and that comes down to obtaining credentials, building a track record, investing in your knowledge, skills, and abilities, and maintaining professional competence. These are all enhancers that can further build trust and establish an edge from other advisors, maybe who only seek to do the bare minimum in terms of what's required by regulation. I think another part of it is probably, so as I said, regulation can create the frameworks. I think the other part of it is having good enforcement, so that when you have a scandal, and sadly these things inevitably happen in our industry, that regulators pursue wrongdoing, there is strong enforcement action, because that in turn creates trust that if you're a retail investor who has been on the wrong end of a financial scandal, you want to see some accountability and you want to have trust that the regulator will protect your interests. So enforcement is definitely part of the regulatory solution to supporting and underpinning trust. And unfortunately, regulation has probably been a little bit inconsistent on the enforcement side. Clearly, there have been a number of initiatives at the EU level looking at market abuse and looking at sanctioning regimes to level up the level of regulatory enforcement. But it's not been always the case that every market has consistent levels of regulatory enforcement. So it really boils down to supervision and enforcement, supporting and underpinning the foundational expectations that are established in rulemaking. As I said, that's not always as strong as perhaps it could be.
Thanks. Do you have examples that would describe how a firm has been successful in enhancing its brand identity and credibility?
That's a great question. It's hard for me to answer that without kind of picking out individual firms. I mean, it's not something that I would like to say. This firm has got a great brand, and another firm doesn't. But if you look at the large firms that have been very successful, I think it's fair to say that they have strong brands, and that's part of attracting business, attracting fund flows. Clearly you have to market yourself very effectively, but having a strong brand, having a strong marketing operation to attract that business is part of it. I don't know, maybe I can pass that one to Philippe. Any observations or comments around brand or organizations that have particularly strong brands?
Well, France is not the ideal country for branding because the retail market being what it is, there's not a lot of marketing activities from French asset managers towards retail investors. But I would agree the large international players, the Fidelity, the BlackRock of this world have done a decent job in those countries where it is accepted and recommended to advertise to create a very strong brand.
Thanks, Philippe. So we have another question for Philippe. Could you share your views on how independent advisors are gaining traction in France? What are the challenges and opportunities they are facing?
The opportunities are enormous because there are no independent financial advisors in France. 99% of the profession chose to remain non-independent as per MiFID II and stay in their comfort zone of being paid by product providers. So this is a call to CFA charter holders. There are very, very nice careers to be made in the advisory market in France. And if you are independent, and this is something I've been doing, and I have to provide some clarification to what Jean-Philippe said. I used to be a financial advisor. I no longer am a financial advisor, but this is something I've been doing for the past 2 years and which I've recently stopped doing, being independent with another CFA charter holder. And I can tell you there is a huge market, provided you invest the necessary time and resources to explain to would-be clients how the retail market works and what are the pros and cons of being compensated by product providers versus clients. So there is a huge potential on the French market, but it's not tapped now. It's totally untapped.
Thanks, Philippe. Does trust correlate with the size of the asset manager, and how can a small asset manager or boutique compete in this aspect?
Yeah, that's a great question. I'm not sure that is necessarily the case, that trust correlates with size. That's not a dimension of trust that we've evaluated specifically. We see trust correlating with brands. So if you think size correlates with brands, then yes, maybe. But hard to answer that because it's not a specific dimension that we've looked at. But yeah, it's a challenging environment operationally for smaller shops, for boutique asset managers, clearly. You see that from regulation, from competition, fee compression. And this is another one of those issues, you know, having a good brand to attract fund flows. It's another competitive threat, no doubt.
Thanks, Rodri. How do you think the COVID-19 pandemic will affect trust levels in the financial industry?
Maybe I can take a first pass of that and then turn to Philippe to comment. So, you know, as I said, we did this survey at the back end of 2019, and then as we were looking to launch this piece, yeah, clearly we had a big market dislocation following the outbreak of COVID-19. We did some analysis to sort of look, you know, over the past 4 versions of this trust study. Is there any kind of clear correlation between financial markets and performance and trust levels? And we didn't really see that clearly. As I said, clearly, you know, with all of the ramifications of COVID-19, the impact on the economy, on people's jobs and livelihoods, you know, trust in your advisor and the ability for your advisor to stay true to your investment strategy, all of those issues are going to come in the strain. There's no doubt about that. But we would like to think that, you know, the elements of trust that really matter, you know, credibility and professionalism, these are long-term enduring features that should last irrespective of the market cycle. So I think, you know, if you can demonstrate your adherence to these kind of core components that we've outlined in the trust equation, I think ultimately over time that will stand you in good stead. You know, if you can stay true to your client's investment objectives, stay the course, be a good and transparent communicator through that period, it's possible to actually continue to enhance trust rather than see a loss of trust just because of short-term market fluctuations. But clearly all of the, you know, the direct consequences of COVID-19 from an investor standpoint, as well as the indirect ones on the economy, on people's livelihoods, on supply chains, et cetera, you know, these are bound to have an impact that will put strain on trust and those relationships. Philippe, is there anything you want to add to that?
No, not much. I don't think that COVID can increase trust in any profession except the health profession. But as you said, the financial services should play a long game, and one day, eventually, COVID will be behind us.
Thanks. So we do have a comment just now. When we see that the markets, so asset prices, have come back, not to initial levels, but far from them, while companies' profits have fallen massively, trust looks high given the COVID. Do you care to comment?
So trust is the comment is, if I'm understanding it correctly, trust is high relative to, you know, where the economic environment is currently, and so I'm just looking at the chat that's coming in here from Natalie. Low profits, high prices, price to earnings is very high, so the market's kind of overvalued, arguably. You know, that's possible. I think in an ideal scenario, it would be fascinating to ask some of these questions again. So as I said, when we did the survey, it was the back end of 2019, very different market environment. We had, you know, we were in the latter stages of a long bull market. Possibly you could argue some valuations were relatively stretched in some markets even at that point. But, you know, clearly a very supportive market environment on which to ask these survey questions. You know, it would be interesting to see if we had a significant difference if we were to repeat the survey in the current market environment. But as I said, I think some things are, you know, enduring irrespective of the market cycle. When you talk about fee transparency, commitment to professionalism and ethical orientation, I think these things are independent of the current market backdrop for sure. We also asked about the preparedness of the industry to manage through a financial crisis. If I recall the statistics, around half of retail investors thought their firm was well prepared, and around 2/3 of institutional investors thought that their manager was well prepared to manage through the crisis. So there was some, I guess, confidence coming into this, that the industry was, you know, at least, let's say, better prepared than the previous crisis to deal with the fallout and the shock that has hit economies globally. It's a very different crisis. Obviously, it's not one that's originated from in the financial industry this time. It's an exogenous shock. And if you look at the ability of the financial industry to absorb that in terms of capitalization levels, profitability, lending, we're starting from a much better position than the previous one in terms of the ability to weather that storm. Now, really what matters at this point is what happens next. And it's anyone's guess, are we going to have a V shape, a W shape, any other shape sort of recovery? I wouldn't like to speculate on that, but yeah, that's really what matters at this point in terms of justifying those fundamentals and valuations.